Welcome back. I'm John A.G. All right, today is not a normal market update. This is not about one candle or one headline. This is about the machine under the market, the liquidity pipe, the dollar pipe, the political pipe. And if that pipe opens wider again, then the headline will not be stocks are strong. The headline will be the currency is being asked to carry too much weight. Because understand this clearly, a market can rise while people get poorer. A stock index can print new highs while bills crush families. Bonds can stabilize while purchasing power leaks out the back door. So when you hear that liquidity is coming, the first question is not, will the Dow go up? The first question is, who gets the money first? And before we go deeper, do one simple thing. Subscribe to this channel and comment John AG below so the algorithm knows this conversation matters. If you have been watching quietly and this message makes sense, do not stay invisible. The comment section is not decoration. It is where this community shows whether people are actually preparing, learning, saving, and thinking ahead. One serious comment can push the video to someone who needs it before the next policy shock arrives. That matters more than most people realize, especially now, while the signals are getting louder, fast. Now the core. The Federal Reserve's official monetary policy goals are maximum employment, stable prices, and moderate long-term interest rates. That is the textbook language. But markets do not only trade on textbook language. Markets trade on what policymakers do when the system starts shaking, and that is where the real argument begins. If the Fed and Treasury believe financial conditions are getting too tight, they have tools. They have liquidity facilities. They have swap arrangements. They have balance sheet choices. They have communication power. They may not call it money printing. They may call it stability. They may call it market functioning. But the market hears one thing: more oxygen. And oxygen does not move evenly. It reaches banks first. It reaches large asset owners early. It reaches institutions with collateral. It reaches the players already standing closest to the machine. Much later, it reaches the person buying food, paying rent, filling a tank, and keeping a family moving. That delay is not a small detail. That delay is the whole story. This is why a rising market can become dangerous if people mistake it for rising prosperity. Look at the structure. Federal Reserve distributional data through Q3 2025 shows the bottom half of U.S. households held only about 2.5% of net worth, while the top 1% held about 31.7%. It means the system is built so asset owners benefit faster when liquidity expands. So if stocks rise because liquidity rises, who gains first? The people who already own stocks. If real estate rises because rates fall or liquidity improves, who gains first? The people who already own real estate. If gold and silver rise because currency trust weakens, who gains first? The people who already prepared. The bottom half cannot hedge the same way. They are not sitting around debating 60-40, 60-20-20, or alternative assets. They are dealing with rent, insurance, energy, groceries, and debt. So when someone says, the market is healthy, the real answer is, healthy for whom? Here is where gold and silver enter, not as magic, not as religion, not as guaranteed profits, but as a signal. When trust in paper promises weakens, hard assets start to matter again. Gold does not need a CEO. Silver does not need a press release. That is why institutions have started rethinking the old portfolio model. In 2025, Morgan Stanley's Mike Wilson discussed a 60% equities, 20% bonds, 20% gold framework, arguing that gold had become a more resilient hedge than treasuries in that environment. It means the conversation changed. And once the conversation changes at the institutional level, retail investors need to pay attention. For decades, people were told the safe model was stocks and bonds. Stocks for growth, bonds for protection. But what happens if stocks and bonds both need the same liquidity support? What happens if both are being held up by the same policy impulse? What happens if the hedge and the risk asset start depending on the same central bank oxygen? That is when gold and silver stop being side characters. But let's be clear. I am not telling anyone to go all in. That is how people get destroyed. A hedge is not a casino ticket. A hedge is there so that if the paper system gets weird, you are not standing empty-handed. For one person, that may mean small monthly silver purchases. For another, measured gold, cash, land, energy, or commodities. The point is not to panic. The point is to stop pretending the old rules are enough. Ask yourself this. If liquidity is so healthy, why are officials discussing dollar swap lines with Gulf and Asian partners? Reuters reported that Treasury Secretary Scott Bessent said the U.S. was in talks around swap lines to support dollar liquidity and prevent disorderly sales of U.S. assets. That is not a small footnote. That is plumbing. and plumbing matters before the flood shows up. Swap lines sound boring. They are not boring. They are a pressure valve. When foreign partners need dollar funding, a swap line can reduce stress. It can calm markets. But it also tells you something important. The global dollar system needs maintenance. It needs valves. It needs backstops. It needs confidence. So again, the question is not whether officials can stabilize markets. They often can, at least for a while. The question is what kind of price gets paid for that stability. If stability means more liquidity, then asset prices may go higher. Stocks may go higher. Bonds may find support. Credit markets may relax. But hard assets may move faster because they are not just pricing growth, they are pricing trust. And trust is the real currency. Now derivatives. This is the part most people skip. They skip it because it sounds technical. But technical does not mean irrelevant. The Bank for International Settlements reported that over-the-counter derivatives outstanding reached about $846 trillion in notional value at the end of June 2025. Notional is not the same as money at risk, but the scale shows interconnection. This is where people make two mistakes. The first mistake is thinking every large number means immediate collapse. It does not. The second mistake is thinking a large, opaque, interconnected market can never create trouble. It can. We learned that in 2008. And no, the lesson was not only that Wall Street made bad bets. The lesson was that when large financial structures get tangled enough, the rescue bill moves from private boardrooms to public balance sheets. And smaller banks were not untouched. The FDIC lists 25 bank failures in 2008 alone, and more followed after that. So the clean version is this. Systemic risk does not stay neatly contained. That is why private credit, off-exchange risk, and derivatives matter. Because when credit is easy, everyone believes risk is diversified. When credit tightens, everyone discovers risk was simply hidden in new places. And this is where AI comes in. AI is being sold as a productivity revolution. Maybe it is. It may reduce costs in some sectors. It may improve margins. It may automate tasks that used to require expensive labor. Kevin Warsh has argued that AI could make almost everything cost less, and described it as an early stage of structural price decline. That is the optimistic version. But here is the uncomfortable version. What if AI reduces corporate costs before it raises living standards? What if companies protect margins by reducing headcount? Reuters reported Meta planned a first wave of layoffs, cutting about 10% of its workforce, linked to an AI-driven efficiency push. AP also reported Meta's cuts alongside Microsoft buyout offers as major companies spend heavily on AI. So the market hears productivity. Workers hear replacement. Executives hear margin expansion. Policymakers hear disruption. And disruption usually becomes an excuse for intervention. If AI layoffs accelerate, the political pressure will not be small. People will demand support. Governments will talk about retraining, stimulus, targeted aid, maybe broader programs. And if markets wobble at the same time, the pressure on the Fed and Treasury to keep liquidity available becomes even stronger. That is how a deflationary technology can still lead to inflationary policy. Let that sink in. A machine can lower the cost of production, but a government response can still expand deficits. A company can cut labor costs, but households can still feel poorer. A stock can rise on AI productivity, while the worker who trained the system gets laid off. That is the tension sitting right in front of us. Now I want to ask you something. If you had to protect purchasing power for the next 5 years, would you trust paper assets alone, or would you want some hard assets beside them? Drop your answer in the comments because this debate matters. And for those of you who have built something, saved successfully, invested wisely, or protected your family through discipline, share that too. People need to hear real success stories, not just fear. Now the Fed leadership question. Jerome Powell's term as chair ends on May 15, 2026, while his term as a board member runs until January 31, 2028. So a chair transition does not automatically remake the institution. Markets love personalities. They want one hero or one villain. But the system is bigger than one chair. If Kevin Warsh takes over, people may expect a tougher Fed, a leaner balance sheet, cleaner discipline, and stronger inflation control. Maybe. But here's the problem. No Fed chair operates in a vacuum. A Fed chair inherits the debt load, the Treasury market, the banking system, the political pressure, the labor market, the derivatives complex, the global dollar network, the AI disruption, the deficits, the expectations. So the question is not whether one person wants discipline. The question is whether the system can tolerate discipline. Because if the system needs liquidity, discipline becomes expensive. If markets are addicted to support, withdrawal becomes painful. If government debt is high, high real rates become politically toxic. If unemployment rises because AI disrupts labor, tight money becomes harder to defend. That is why I do not focus only on speeches. I focus on constraints. A new Fed chair can talk about inflation. He can talk about productivity. But if credit markets crack, if dollar funding tightens, if unemployment pressure rises, or if Treasury volatility becomes dangerous, the policy conversation changes fast. That is where gold and silver watch quietly. They do not move because of one sentence. They move when confidence shifts. They move when real rates, deficits, liquidity, and fear start pushing in the same direction. They move when people realize the system may choose nominal stability over purchasing power stability. And that distinction is everything. Nominal stability means markets do not crash. Purchasing power stability means your money still buys what it used to buy. Policymakers often prefer the first. Purchasing power erosion is slower. It is easier to explain away. That is why people wake up late. They see the index higher and think things are fine. Then they check rent, insurance, food, medical costs, tuition, energy, repairs, taxes. Suddenly, the stock market headline does not feel like their life. This is the gap. On critical minerals, tungsten deserves caution. Pure Tungsten has publicly discussed a path toward first tungsten production from its South Korean project in June 2026 and a planned public listing in 2026. That matters because tungsten is strategic. But valuation claims around small mining companies must be treated carefully, unless they come from filings, audited statements, or official offering documents. Do not confuse a catalyst with a guarantee. A mine nearing production can be exciting. A public listing can create attention. A strategic metal can attract capital. But speculative mining names can move violently both ways. So if anyone talks about billions in value without hard documents, treat it as a thesis, not a fact. That is the correct way to handle it. What is the bottom line? The bottom line is not sell everything. The bottom line is not buy everything. The bottom line is that liquidity is the dominant force. If policymakers keep liquidity available, stocks and bonds can stay supported longer than skeptics expect. But the same liquidity can also weaken confidence in the currency and push investors toward gold, silver, commodities, energy, land, and other hard assets. That is the fork in the road. One path says the system stays stable and asset prices keep rising. The other path says the system stays stable only because the currency absorbs the damage. And if the currency absorbs the damage, then the people without assets feel it first. That is why this matters. This is not just a Wall Street story. This is a household story. This is a paycheck story. This is a savings story. This is a retirement story. If you own assets, liquidity may help you. If you do not own assets, liquidity may show up as higher prices before it shows up as opportunity. That is the split. So watch the Fed balance sheet. Watch dollar funding stress. Watch swap line headlines. Watch gold versus bonds. Watch silver demand. Watch layoffs tied to AI. Watch credit spreads. Watch private credit. Watch whether institutions keep treating gold as an anchor instead of a side hedge. And most importantly, watch what officials do when markets fall. Not what they say when things are calm, what they do when pressure hits. Because that is where the truth comes out. If they tighten into pain, then maybe discipline is real. If they open liquidity again, then the message is clear. The system will choose support, and hard assets will keep gaining attention. That does not mean every day is up. It does not mean gold and silver move in a straight line. It does not mean miners are safe. It does not mean you abandon risk management. It means you understand the direction of the pressure. And right now, the pressure is building around one question. Can the system protect asset prices, fund government deficits, manage AI disruption, support global dollar liquidity, and preserve purchasing power at the same time? That is the real cliffhanger. Because if the answer is yes, markets may keep climbing and the dollar may survive the stress. But if the answer is no, then gold, silver, and hard assets are not just investments. They become votes of no confidence. So stay alert, stay balanced. Do not chase panic, do not ignore signals. And if you believe this channel is giving you value, subscribe now. The next few months are not going to be quiet.